We welcome you to our classes. We are going to have a MCQ session just for you to understand the way we are going to conduct this class. After every question is read out, a pause button is shown. That is for you to stop in case if you need it, your laptop or the phone, and try to answer the question yourself. Then you can resume the system so you can match your answers with our answers. Now let us go to the question straight away. A credit balance on a ledger account indicates A, an asset or an expense, B, a liability or an expense, C, an amount owing to the organization, D, a liability or revenue, before we answer the question direct, we wanted to learn something. So we will just go through. There is a small working prepared for you, which is usually known as the golden rules of double entry or accounts. In this one, if you notice it, there are 5 types of accounts. Sometimes people make it 6 types, or sometimes they make it 4, but whatever it is, all amount to the same. Now we come back here. Now there are 2 debit accounts. There are debit balance accounts, which is assets and expenses. There are 3 other accounts, which are credit balance, liabilities, equity, and revenue. The same accounts, in case if asset has to be reduced, then there will be a credit entry. Similarly, if liability will have to be reduced, there will be a debit entry. So having said this, now most of you all must be very familiar with it. Now we'll go back to the question. Here they say credit balance. The credit balance on the ledger account. That means it is talking about one of these 3 accounts, not these 2 accounts. These 2 accounts are debit balance. The question here is credit balance. So we go back to the question. An asset or an expenditure. So both are debit balance. So this is not relevant to this answer. The second one is liability account, which has a credit balance. Expense account, a debit balance. So there again a mixture of credit and debit, but they are asking is credit balance. So this is also not a possibility. The next one, an amount owing to the organization. It means a receivable. The company has to receive money. Therefore, it is an asset. Therefore, it's a debit balance. That also cannot form the answer. The last one, a liability or revenue. Liability, as you see here, a credit balance. Revenue, as you see here, credit balance. So this should be the answer. I will go to the next question. What would be treated as part of the capital expenditure of the purchase of a building? 1, a cost of purchase, the building price. Installation of air conditioning needed for the machinery in the building. 3, insurance of the building. Now 4 options are given. So we give you a chance for you to answer on your own. Now we go back to the question again. Now there are 2 expenditures. Expenses are known as capital expenditures, revenue expenditures. What is the difference between these 2? Capital expenditure, the benefit of that expense will prolong to over a accounting period. It will stretch to 2, 3, several accounting years. But if it is a revenue expenditure, it will get confined to the accounting period only. If you see cost of purchase of a building, that naturally will remain for longer period. So therefore, that is a capital expenditure. Second one, if you look at it, installation of air conditioning. So that is again an improvement of the building. That also will remain most of the time as long as the building is there. So that is also a part of capital expenditure. The third one, insurance of the building. Insurance of the building, this is only a revenue expenditure because every year you will have to renew paying your insurance. Therefore, the answer should be B, 1 and 2 only. Now we'll move on to the next question. And an organization's year end is 30th September. On 1st January 1996, the organization took out a loan of 100,000 with annual interest of 12%. And interest is payable in equal installments on the first day of April, July, October, and January in arrears. Note the word in arrears. How much should be charged to the profit and loss account for the year 30th September 96, and how much should accrue on the balance sheet? Now, in this type of question, you all have something which can be little confusing. Now, if you notice here, the year ends on 30th September. That means the year starts on 1st October, finishes on the 30th September. But the borrowing account, the loan account starts on 1st January. Now, 1st January is the first day of the calendar. So children sometimes tend to get mixed up. Okay, so you will have to see that in this particular sum, 1st January up to 30th September, only 9 months are involved during the current period. Therefore, the interest will have to be calculated for 9 months. Since it is 12%, 1% for a month, then for 9 months, it has to be 9,000. Now, if you look at these answers, there are only 2 9,000s are there. Therefore, A is not a possibility, D is not possibility. So if you eliminate that, out of this, now one has a accrual balance of 3,000, other one has no accrual, like as if it had been paid on cash. But is that the case? You look at the account which says interest are payable in arrears. You don't have to pay on the first day of the quarter. You will have to pay on the last day of the quarter. Last day only it is provided, and it is paid as it is shown here on the first day of April. That means the next quarter. So every payment is paid in the subsequent quarter. So therefore, there will have to be an accrual expenditure. As you see here, up to September, 9 months, 9,000. There's an accrual of 3,000. So the answer should be B. Now we move on to the next question, where they say, recording the purchase of a computer stationery by debiting the computer equipment at cost account would result in A, an overstatement of profit and an overstatement of fixed assets. B, an overstatement of profit and an understatement of fixed assets. C, an overstatement of profit and understatement of fixed assets. D, an understatement of profit and overstatement of fixed assets. Now, if you look at the question, what has happened here is purchase of a computer stationery, which is an expense expense account and debited to a computer equipment account, which is an asset account. So in short, what has happened is an expenses have been shown as an asset. This is what has happened. So after that, now if you see, the expenditure is understated, asset is overstated. This is what has happened in this question. Now here, if you look at it, you know where the expense, the word is mentioned here. So quite naturally, if you think carefully, you will know when the expenses are understated, profit is naturally overstated. When expenses are understated, profit is overstated. So what has happened in this question, if you see it very carefully, profits overstated, assets overstated. Now in this one, if you see, an overstatement of profit is shown in two places. Understatement of profit, so there is not an understatement, so B and D are not the possibilities. Now here, look at it, there is a, in this question, if you see, there is an understatement of fixed assets. But in the question we said it is an overstatement of assets. So therefore the answer should be A. Now we will go back to the next question. An accounting concept or convention which in times of rising prices tend to understate assets value and overstate profit is the going concern concept, prudent concept, realization concept, historical cost convention. Before answering the question, we will take this opportunity to learn something. Perhaps you all are aware what it is, but this is just to remind and just recapitulate what we have studied. For the first one is going concern. Going concern is in a foreseeable future. Is there any major obstacles where the continuity of the business will become doubtful? Maybe due to legal reasons, maybe due to financial reason, maybe due to some other reason. It should be the next few years or next year or the year after. In such a short period of time, is there going to be an obstacle running this business? Sometime, the company may be selling a product which perhaps there is an injunction by the government that this product cannot be sold due to maybe health or various other reasons. So this business will have to be closed. So this is not a going concern. Or sometime, there can be heavy load of liabilities. The company is unable to meet its commitments. In such time also, the company may have to be closed down. So that is also not a going concern situation. So why this is important in our accounting is, suppose you say now we have an asset which has a lifetime of 5 years. If the business is going to close in 1 year, how can you hold an asset for 5 years? So that asset will have to be written off on the first year itself. So like this, every accounting entries, the approach of it will vary. That is going concern. Prudence concept is, we take the profits only after it is realized, after it is really earned. We are not talking about received, after earned. But if you foresee a expenditure or a loss, then we will immediately take that into account. We will not wait till that really occurs. So if you take the profit in advance, then if it doesn't realize, you will have to go back. But if you have the losses or expenses foreseen, then it is the best policy to keep that money within the business. How you can keep it? Only by charging that to the profit and loss account. If you see the other one, revenue recognition principle. Here again, if you want to recognize an income or a revenue, it has to be fully earned. Even if you know that the revenue is there, the possibility is there, unless it is earned, you can't take that into account. For an example, now say on the last week or the last day of the accounting year, you got a sales. But still, you have not delivered the goods, you have not invoiced them, they did not collect the goods. So in that case, you are sure that you have got a sales, but the sales is not implemented as yet. The stocks are still in your warehouse. So in that case, you can't take that into account. Now we'll go back to the other one, historical cost. Historical cost is the actual purchase cost of the asset or the expenditure, whatever it is. That is the history, what you really spent. Now we'll go back to the question. Here the question says, in times of rising prices, so the prices keep on increasing every day or over a period of time, it is increasing. Then this will make two things happen according to them. One is understate the assets value. For an example, if you buy a stock at the rate of 50, now the price has gone up, the market price has gone up steadily up to 75. So even though you say for an example, you have 20,000 pieces of that stock, you will multiply that by 50 and then you will have a value, but the real value of it is 20,000 multiplied by 75. So the asset shown here is understated, but you will make no adjustments, but at least you will understand the asset you show is more valuable than what it is shown at. The second one is overstatement of profit. Now you say when your cost is low, the market price is high, then naturally based on that the selling price also will be higher. So therefore the profit, now what is shown here, now suppose you say that you sell only 1,000 pieces of that product, usually you might have a certain amount of profit. When you sell the same 1,000, you will see a much increased sales value and much increased gross profit. But it does not really mean you have sold more or you have sold better. It is only because of that rising price factor, right? Rising prices, this appears to be this. Now we'll go back to the question. Is it a going concern concept? No, going concern concept is talking about the continuity of the business. Prudent concept is your assumption. You take income after it is realized, expenses or losses as you see. At the first occasion, you will write it off. So this is nothing to do with that. Realization concept, here we don't have anything to realize. We are only talking about a rising price situation. Then it is based on the historical convention. Now, every time the prices rise, we don't increase the value of the stock, what we actually pay. What we actually pay will remain in the account. That is why it is called historical cost convention. I hope the students have understood, and we have just made some, as usual, every time when we answer a question, if there is an opportunity to explain further, which we do. Perhaps in any case, if you are not understood or not clear with the answers, or if you have any clarifications, you can contact us on these numbers. And we have a YouTube channel. Most of the time, we will upload these classes into it for some time to remain, for students to go back and browse it, or if there is anything they need to do. But in our original Zoom classes, where there will be interaction between the students and the teacher, so there are the clarifications. So any questions can be raised and answered then and there. So in case anybody wants to join our Zoom classes, they may contact us on this number. Thank you very much, and we will meet again.